So let's talk about one of the weirder stories to come out of this earnings season, STMicroelectronics. Now, here's a company that posted a solid beat on its Q3 numbers, but the market absolutely hammered the stock in response. So what on earth is going on here? Well, we're going to break down the numbers, unpack why the market panicked, and then take a look at what could be next. Okay, let's just dive right into the heart of the matter, because this is the central puzzle. On one side of the coin, you've got earnings per share that beat what Wall Street was expecting by a whopping 26%. I mean, that's a huge beat. But on the other side, the stock just cratered, plunging over 13%. That's not a small dip, folks. That's a massive disconnect. And it tells you right away that the real story isn't in those headline results. All right, first things first, let's just quickly run through the numbers. We need to see what the Q3 results actually looked like, because on the surface, they really seemed pretty solid. So the bottom line was definitely strong. We're talking 29 cents per share. The consensus on the street was for 23 cents. You do the math, that's a clean, impressive beat. Normally, this is the kind of number that sends a stock higher. And the top line, the revenue, also came in a little bit ahead of what people are expecting, $3.19 billion. Look, it wasn't a massive beat, but hey, a beat is a beat, right? It just adds another checkmark to the positive side of the story. And here it is. This is our first major clue as to what went wrong. While EPS and revenue looked okay, the gross margin just fell off a cliff. We're talking a contraction of 460 basis points. That's 4.6 percentage points wiped out year over year. That is a huge drop in profitability, and it's a giant red flag that something's not quite right under the hood. So here's the absolute key to understanding this whole thing. The market wasn't trading what happened in the last 3 months. No way. It was pricing in what it expects to happen over the next 12. That massive sell-off was all about the future, not the past. And what we have here is really a perfect storm of worries. First, their guidance for Q4 was weaker than you'd normally expect for the season. Then you've got this ongoing squeeze on margins because their factories aren't running at full steam. On top of that, their two biggest customer groups, auto and industrial, are still trying to burn through a huge pile of inventory they already have. And to top it all off, a nice little revenue stream they had is expected to dry up over the next couple of years. It's a lot. This quote right here from our research desk just nails it. That little bit of good news from the revenue number, it was completely washed away by this huge wave of bad news about the future. The market just looked right past the Q3 beat and zeroed in on all the trouble brewing on the horizon. And hey, just so we're all on the same page, when we say destocking, what we're really talking about is STM's customers, the car companies, the industrial firms, looking at their warehouses and saying, whoa, we have way too many chips. So instead of buying new ones from STM, they just use up what they already have. And that, of course, puts a direct dent in STM's sales. Okay, so the outlook is tough. We get it. The big question is, what's management going to do about it? Well, they're calling 2025 a transition year, and they've laid out a pretty clear strategy for how they plan to get through it. And their game plan is really a classic three-pronged approach. You could call it a defensive playbook. First, they're going to tighten the belt and cut back on spending. Second, they're going to get their house in order by making their manufacturing process more efficient. And third, they're going to put their money and people on the parts of the business that are still growing, like imaging sensors and microcontrollers. Now, this cut in capital expenditures, or Capex, is a really big deal. They're taking spending down from over $2.1 billion to under $2 billion. This is management sending a clear signal to Wall Street saying, hey, we hear you. We're focusing on financial discipline and generating cash, not just growing at any cost. All right, so let's put on our analyst hats here. We've seen the good, the bad, and the plan for the future. So where does this leave the stock? Here's our official take from the Talk Ticker's desk on what you should expect next. We think their revenue and earnings are probably going to come in right about where management said they would. The really big question is what the stock price will do. And honestly, we see it being stuck in a range for a while. The market has punished the stock. Most of the bad news is likely priced in now. The focus is shifting to 2026 and whether we'll see a recovery. Because of that, we're slapping a market perform rating on it. The short-term challenges are very real, but management's plan should act as a floor under the stock price. All right, before we wrap this up, let's have a little fun. Let's pitch something a bit more aggressive to the investment committee. We like to call this the outrageous but plausible trade idea. So here's the play. It's a pairs trade. You go long on STMicroelectronics, and at the same time, you short the big semiconductor ETF, the SOXX. Now, the logic here is pretty straightforward. STM has been beaten down way more than its peers. The bet is that as management starts to execute on their turnaround plan, STM stock will start to close that gap and catch up to the rest of the sector. It's a way to bet on STM outperforming even if the whole industry just treads water. So what's the final word here? Look, the whole story for STMicro has been rewritten. The stock took its medicine for the weak outlook. From here on out, it's all about one thing and one thing only: execution. Can management actually deliver on their promises? The ball is officially in their court. And as always, just a quick and important reminder, this analysis is for informational purposes. It is not financial advice.